Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Gilead stock so we can determine if it's a buy or a sell. Gilead is a biopharmaceutical company that's focus is on researching and developing antiviral drugs used in the treatment of HIV/AIDS, hepatitis B and C, influenza, and COVID-19. The company is headquartered in Foster City, California, and was founded in 1987. Let's get started with the model. This is a large cap company, 98 billion market cap. They're trading at $78 a share, and they have 1.3 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow peaked in 2021 at 11.4 billion. It's still pretty high in 2022, over 9 billion, higher than 2020 and 2019. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was really low in 2020 due to lots of write-downs, but it came back in 2021 at 6.2 billion. It's 4.5 billion in 2022. Revenue is a sales for the company, and that grows steadily from 22 billion to 27 billion. They recently released their first quarter earnings, and for the first quarter of 2023, revenue of 6.4 billion, down from 6.6 billion. Let's dig deeper into the 6.4 billion so we know what it is. Their bread and butter is HIV drugs. 4.2 billion of the 6.4 billion of revenue. Of that 4.2 billion, most of it is in the US, 3.4 billion, 500 million in Europe. Oncology, 670 million. That's a treatment of tumors and cancer. Liver disease, 675 million. Hep C, 445 million. Hep B, 230 million. Their drug Veklury is used for COVID-19 patients. That was 600 million. And others 200 million. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue. 1.4 billion, same as last year. R&D 1.4 billion, higher than last year. Acquired in-process R&D 480 million. SG&A 1.3 billion, up from 1.1 billion. Total expenses are down a lot, from 6.4 billion to 4.6 billion. The reason it's down a lot is because of this large impairment last year, 2.7 billion. They impaired their in-process R&D. Let's learn about these numbers a little deeper. This is from their 10Q. R&D expenses are mainly personnel costs, including salaries, benefits, and stock-based compensation. Also infrastructure, materials and supplies, and other costs. Research and clinical studies performed by contract research organizations and our collaboration partners and other outside services. SG&A, selling, general, and administrative expenses, are mainly personnel costs, facilities and overhead costs, outside marketing, advertising, and legal expenses, and other general and admin expenses related to sales and marketing, finance, human resources, legal, and other admin activities. They mention SG&A increased by 22%, mainly due to increased commercial activities in oncology and also increased corporate spend, including an increase in our allocation of the branded prescription drug fee and corporate grants. They spent 230 million of interest on their debt, a little lower than last year. Net income was 1 billion. Last year they were flat. The reason they were flat is because of that large impairment. EPS improved from 2 cents to 81 cents. And they've been buying back stock because they have less shares outstanding in 2023 compared to 2022. Let's look at the capital structure. 21 billion of equity, 25 billion of debt. They're 46% equity, 54% debt. Their net debt is 17.6 billion. So that means they have about 7.5 billion of cash on their balance sheet. I gave them a WACC of 8.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated our terminal value, which is all cash flows past year 4, that's 180 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $165 billion. We divide that by 1.3 billion shares. And we get a calculated stock price of 132. They're trading at 78, so they're trading at a 41% discount. It's a really strong buy according to the model. Simply Wall Street values them at 159. They say the stock is 51% undervalued. 11 analysts price this stock and the average price target is 93. The low is 80, the high is 115. 25 analysts price this stock and the average price target is 92. They say the stock is 18% undervalued. This is where the stock has been trading since 2002. So you can see they did 4 stock splits because as the stock price goes up, a company does a split, so each share is less and more affordable to the general public. The stock pretty much only went up from 2002 to 2008. Then the Great Recession hit and it was a bit of a decline. It looks like it got to a low of about $18. That was in the beginning of 2010. Then there was a huge bull run over the next 4 years and it peaked at 120. It never got that high again. And that's when they started paying a dividend. And once they started paying a dividend, the stock went down. In 2017, it reached a low of about 65, and ever since then, it's pretty much been trading sideways for the next 6 years, in a fairly tight range between 65 and 75 for the most part. This bottom chart tracks their quarterly revenue. In the most recent quarter, in the first quarter of 2023, their revenue was $6.35 billion. So you can see back in 2016, 2015, they had the highest revenue. It looks like it peaked at about $8 billion per quarter. But look how their revenue almost exactly tracks their stock price. That's really interesting. So if you want to know where Gilead's stock price will go, just follow their revenue. I always thought cash flow was king. Apparently, revenue is king in this case. They pay a nice dividend. It's a yield of 75 cents per share, up from 57 cents in 2018. They raise it each year, which is 41% of their free cash flow, 82% of their net income. There are 15 companies in the same industry as Gilead, and if Gilead has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend less than the median in CapEx, $600 million. They're a bit more leveraged than the median, better than the average. They pay a higher dividend than most. Their free cash flow is at the median. They're smaller than the average company. They rank 11th in market cap. They have really good price multiples. All their numbers are better than the median. They generate less revenue than the average, but more revenue than the average as a percent of their market cap. And they're not really growing anymore. Their 5-year annual revenue growth rate is only 2%. To summarize, I have them trading at a 41% discount. The company has been around 36 years. They pay a solid dividend and they bring in lots of free cash flow. So it looks like a pretty good company to me. I rank their free cash flow 6 out of 10, their revenue 7 out of 10, and their ratios 8 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to become a member, click on the link in the description below. Thanks for watching.